Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at IonQ.
If you find our talks useful, please consider subscribe, like, and comment underneath. So we really need to talk about a glaring paradox today.
Oh, definitely.
Like, instead of thinking about modern software, imagine we're back in the 1950s.
Okay.
And you're trying to build one of the very first mainframe computers.
Right.
The math works. You know, the government is just throwing massive contracts your way, and you are generating staggering revenue growth. But there is a massive catch here.
Right, the market reaction.
Exactly. The crowd watching your company is actively betting against you because you aren't just writing the software. You're burning through cash trying to forge your own vacuum tubes and basically build the whole assembly line from scratch.
Yeah, and what's fascinating here is that the disconnect just couldn't be starker.
Mm.
On one hand, you have a business whose revenue is just exploding. Like, they were up 287% year over year in the second quarter. They just raised their full-year guidance, and they're winning these mission-critical space and defense contracts.
Right. But then you look at the stock chart.
Yeah.
For the last 13 weeks, it's down nearly 34%.
Exactly. So our mission for this conversation is to figure out that disconnect, between these absolute record fundamentals and the really lagging price action.
Yeah.
But before we get into all those details, here is a quick word on a really useful research tool. We use StockOracle, which is an AI-aided stock research platform to help long-term investors organize fundamentals, intrinsic value estimates, and AI moat analysis.
Right.
You can explore it through the special 14-day trial link below in the description. Now, this is a research platform, so it is not financial advice or a recommendation to buy or sell anything.
Super important to remember.
Definitely. And keep in mind that AI analysis and valuation estimates, they could be incomplete or wrong, and data may be delayed, so you must always verify important facts and make your own decisions. Also, this is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context.
Okay.
Because if we're looking at this properly, we are not treating IonQ as some quick swing trade.
No, definitely not.
It fits a very specific investment profile. It's a high volatility, long-term compounding play. And it's really designed for highly risk-tolerant investors.
Right.
You're essentially betting on a pure-play quantum computing company that's trying to cross the chasm from, a highly speculative science project into an actual validated commercial growth platform.
Which means you are absolutely not buying this for a stable dividend next quarter.
No way.
The entire opportunity really hinges on two things. It's the velocity of government and defense adoption, and whether their underlying tech can actually maintain a competitive moat.
Right.
And that technology is crucial to understand here. They use what's called vertically integrated trapped ion technology.
Which, that sounds incredibly dense.
It really does.
For anyone trying to wrap their head around how this actually functions, what does trapped ion mean in practice?
So think of it this way. A lot of the early quantum computers, like the ones built by the massive legacy tech giants, they use superconducting circuits.
Okay.
The problem is, to make those work, you have to cool the system down to like a fraction of a degree above absolute zero.
Oh, wow.
Yeah. It requires massive, highly complex refrigeration systems.
Right, which sounds expensive.
Very. What this company does instead is they use precision lasers to literally trap individual charged atoms, which are ions, in a vacuum.
Okay.
And because they are isolated in a vacuum, you don't need those extreme freezing temperatures to maintain the quantum stability.
Oh, I see.
It's highly accurate, the error rates are lower, and you can actually run them at room temperature.
But the catch there is that manipulating individual atoms with lasers is, incredibly hard to mass produce.
Exactly. It's brilliant science, but scaling it into a commercial product that you can just stamp out in a factory, that's the ultimate bottleneck.
Yeah.
And that's why their entire narrative is shifting right now from proving the physics works to proving the manufacturing works.
That gives us the bigger picture. Now let's look at the fundamentals. Because the market is hyper-focused on how much it costs to build that manufacturing base.
Right. And the growth story here is really exceptional on the top line. I mean, in Q2 2026, revenue hit $80.1 million.
Yeah.
Like I said earlier, that is up 287% year over year. And if you look at the first half of the year as a whole, they reached $144.7 million.
That's a huge jump.
It is a staggering jump.
Yeah.
Compare that to the first half of 2025, which was just over $28 million. That's a more than 5x increase.
Yeah.
And management is seeing so much momentum in their pipeline that they raised their full year 2026 guidance to a range of $280 million to $290 million.
Okay, so here is where I have to bring in some heavy practical skepticism.
Fair enough.
Because when you look past that massive top-line growth, the profitability picture is incredibly muddy.
It is.
In Q2 alone, they reported a net loss of roughly $1.87 billion.
Yeah, that's a big number.
That is a B for billion. When investors see a number like that, alongside, $80 million in revenue, it sets off every alarm bell imaginable.
It sounds terrifying until you actually look at the accounting mechanics behind that specific number.
Right. We do have to clarify what is actually happening on the balance sheet there.
Yeah.
That massive billion-dollar loss is largely a distortion. It's caused by non-cash warrant liability charges.
Right, the mark-to-market accounting.
Exactly. When the company went public, they issued warrants, which are essentially options to buy the stock at a certain price. And as the company's underlying valuation fluctuates, accounting rules force them to revalue those warrants every single quarter.
Yep.
So if the calculated value of those liabilities goes up, they have to record a loss. But it's a paper loss.
Right.
It is not actual cash flying out the door.
Exactly. It's an accounting quirk, not a daily operational hemorrhage.
Yeah.
But I will say your skepticism is still warranted, because even if we strip out that paper loss and look at the underlying cash burn, it is still undeniably heavy. Adjusted EBITDA was negative $120.3 million. And if you look at their operating cash flow for the first half of the year, the burn nearly tripled year over year to negative $254.8 million.
And that's the number that matters. I mean, they burned over $250 million in 6 months just running the business.
They did, but, they also have a massive safety net.
Okay.
Following their recent acquisition of Skywater, they are sitting on approximately $2 billion in pro forma cash.
Wow.
So they have runway. Meanwhile, their gross margins are currently sitting at 36.11%.
Yeah. See, I need to push back on that setup, though.
Okay.
They have $2 billion, sure. But if operating cash burn tripled to nearly $255 million in 6 months, that runway shrinks a lot faster than people realize.
That's fair.
It begs the question, are they just buying top-line numbers?
What do you mean?
Well, you can grow revenue 287 out of 10 if you spend aggressively enough to acquire it. But at a 36% gross margin, how is that sustainable? A traditional software company usually operates at 70 or 80% gross margins. You can't just brute force your way to profitability if the core unit economics don't scale.
That is the pivotal question right there. But I would argue that a 36% margin is not unusual for a technology platform company in this specific early commercialization phase.
Okay.
They aren't a pure software company, right? They are building highly specialized hardware.
Yeah, that's true.
The thesis is that as they scale their manufacturing and achieve higher utilization rates on their systems, those margins will expand significantly.
Which means they have to clearly justify that heavy cash burn to the market. We can't just hope margins expand. We need to break down the exact engines driving this revenue.
Right.
Just to see if that path is realistic.
Let's do that. So the current revenue comes from their existing engine, which is almost entirely government and defense.
Okay.
And they have real multi-year revenue visibility here. For example, they recently secured a $28 million contract extension with DARPA, specifically focused on atomic clocks.
Which is fascinating. I mean, they are using quantum technology to build atomic clocks because the military needs absolute precision timing for navigation.
Exactly.
In environments where GPS is jammed or denied, it takes this abstract quantum concept and applies it to a very real mission-critical defense need.
Yes, exactly. It's a highly practical application.
Yeah.
They also have an ongoing partnership with the NRO, the National Reconnaissance Office.
Oh, wow.
And internationally, they are integrating their commercial quantum systems into the Canadian Fabric Quantum Sandbox.
Right.
So the government validation is absolutely there.
So that is the established pipeline, right? The software and system integration side.
Right.
But then we have this massive structural shift, the emerging engine, which goes back to that Skywater acquisition you mentioned.
Yeah.
Why does a quantum computing company need to buy a whole manufacturing facility?
It comes back to the trapped ion tech we talked about earlier.
Yeah.
By acquiring Skywater, they are bringing the manufacturing layer entirely in-house. They're vertically integrating. The strategic value here is reducing their dependency on external third-party supply chains.
Right.
When you're dealing with precision lasers and vacuum chambers, you can't just outsource your components to a standard semiconductor fab. Owning the manufacturing stack is how they plan to pull those 36% gross margins upward. It creates a massive competitive moat.
It's an aggressive move, for sure. I mean, think about it like Apple designing its own
Oh,
silicon.
that's a good comparison.
Yeah, for years, Apple relied on Intel. But when they finally stopped relying on third parties and built the M-series chips entirely in-house, it gave them total control over both performance and margin.
Exactly. It was a game changer.
But here is the reality check on that. Bringing manufacturing in-house is a massive upfront capital drain. Do they actually have the operational chops to execute this? Integrating a whole manufacturing company usually comes with intense cultural friction between, the theoretical physicists designing the computers and the factory operators trying to build them. There are always hidden costs.
And that friction is exactly why the broader market might be hesitating. They have to prove they can run a factory, not just a lab.
Right.
But there is also a third engine here, which represents pure optionality. And it is completely outside of traditional quantum computing. We are talking about space-based networking.
Hey, okay, walk me through the mechanics of this, because this sounds completely out of left field.
It does, yeah.
If they're building quantum computers and the factories to make them, how does space factor in? Are they putting quantum computers in orbit?
Not exactly. This operates under their subsidiary, Skyloom.
Okay.
You have to understand that as quantum computers become more powerful, they eventually need to talk to each other to scale up.
Right.
You can't just plug them into standard underground fiber optic cables because the delicate quantum state, the entanglement, degrades over long distances in regular glass fibers.
Oh, I see.
So to transmit quantum data securely over long distances, you need secure optical space terminals.
So they are building the network infrastructure for the future.
Exactly. And Skyloom recently deployed dozens of these optical terminals into orbit for the Space Development Agency, the SDA.
Wow.
They are helping build out what's known as the Proliferated Warfighter Space Architecture. It extends their total addressable market far beyond standard quantum computing. They're becoming a defense communications player as well.
That brings us to the catalyst timeline. Because this cash burn is a ticking clock, the market is completely obsessed with how fast they can prove all these moving parts actually work together.
Right.
Which means over the next 3 to 12 months, there is zero room for error on revenue execution.
No, in the near term, the absolute biggest focus is H2 2026 revenue. The market needs to see if they can actually hit that raised $280 to $290 million guidance in the third and fourth quarters.
Yeah.
And simultaneously, investors will be tracking the active Skywater integration process, which the company has been detailing in recent August 8K filings. Any sign of integration delays will be heavily penalized.
Okay, so H2 revenue is the immediate hurdle. But even if they clear that, they still need massive government validation to survive the next few years. For the medium term, are we just waiting on DARPA and the NRO to drop new contracts?
That, and we want to keep an eye out for additional deployment phases for Skyloom with the SDA.
Right.
The faster they prove the space optical network functions, the faster that becomes a standalone revenue pillar. And then long-term, we're looking at broader industry tailwinds, sentiment shifts regarding government equity investments in quantum tech, and rising overall defense budgets.
But let's go back to that near-term revenue catalyst.
Okay.
Management raised guidance to $290 million on the high end. My concern is whether that is already fully priced in by optimistic growth investors. Because at these current valuation multiples, if they come in at, say, $275 million, which, by the way, is still massive growth,
Right.
doesn't the stock just get absolutely punished for missing perfection?
That is the perfect pivot to the chart. Catalysts tell us what could change the story. Now let's pivot to the chart.
So what does market sentiment look like?
The technicals tell us exactly how much optimism is actually priced in right now. And the market sentiment is heavily bearish.
Yeah.
The current price is sitting at $40.03. Over the last 13 weeks, as we noted, the stock is down nearly 34%.
Wow.
It is currently trading below its 20-day, 50-day, and 200-day simple moving averages. The RSI is sitting completely neutral at 50.54.
And we need to highlight the sheer volatility here. The beta is 3.45.
Yeah.
For context, a beta of 1 moves with the broader market. A beta of 3.45 means this stock moves violently, way more aggressively than the market average in both directions.
Right.
And despite the recent drop, it is still trading at an elevated price-to-sales ratio of 95.5. You are paying 95 times trailing revenue.
Yeah, that's high.
And here is the major red flag for me. Contrast all the bullish corporate news, the raised guidance, the 287% growth with the recent insider activity.
The insider selling is definitely a notable headwind.
The management to superior performance ratio, the MSPR, is negative 33.97. Over the tracked period, we saw 9,329 shares sold by insiders and 0 open market purchases.
To be fair, 9,300 shares is a relatively modest volume being sold.
It is, yeah.
But you are right, the complete lack of open market buying from insiders while their own stock is down 34% tells a story.
It really does.
The analysis here is pretty clear. The market isn't doubting the revenue growth itself. The chart shows the market is heavily discounting the stock because of execution fears and the lack of a clear near-term path to profitability.
Right.
That sentiment picture is useful, but we still need to talk about the risks.
Which means we need to clearly lay out what could go wrong here.
Yeah.
The biggest risk staring us in the face is the execution and integration of SkyWater.
Absolutely.
If they fail to integrate that manufacturing smoothly, they didn't just buy a competitive moat, they bought permanent higher costs and severe margin pressure.
And if that integration stalls, it forces eventual shareholder dilution. Yes, they have that $2 billion cash pile right now, but if the factory becomes a money pit, that cash goes incredibly fast.
Yeah, exactly.
They'll be forced to issue more shares, punishing current investors.
Which ties directly into the second major risk, the cash burn trajectory itself. The fundamental threat is that the $254.8 million operating cash burn outpaces their revenue growth permanently,
Right.
preventing the company from ever achieving operating leverage. If they can't scale revenue faster than expenses, the whole model breaks.
It does.
And beyond the financials, we just can't ignore the existential threat of competitive obsolescence. You have well-funded rivals like Quantinuum aggressively pushing their own full-stack trapped ion tech.
And quantum computing is brutal because it is largely a winner-take-most industry.
It really is. If a competing technology modality, maybe the superconducting approach from the legacy giants, or maybe photonics, or even a rival's trapped ion setup, if they achieve clear, undeniable commercial advantage first, IonQ's platform could theoretically go to zero. It wouldn't matter how much momentum or cash they have today if the underlying tech is suddenly deemed second best in a field that demands absolute superiority.
That is the grim reality of pioneer tech.
Sure.
But let's balance those downside risks by looking at the flip side. Let's balance the downside risks by looking at what happens if management executes perfectly over the next few years.
Okay.
Let's map out the 3 to 5 year blue sky scenario.
Sure.
But to be exceptionally clear to everyone listening, this is an optimistic scenario. Based on their current trajectory, it is not a prediction.
Right. So in that blue sky scenario, IonQ scales up to multi-billion-dollar revenue levels.
Yep.
The SkyWater acquisition is smoothly integrated, which allows them to completely control the hardware stack, driving those gross margins up from 36% to software-like levels.
Exactly.
Meanwhile, Skyloom evolves into a massive multi-billion-dollar second growth engine focused purely on defense space networking. They aren't just selling computers, they're selling the secure network those computers run on.
And the result of all that operational execution is that the company organically re-rates.
Yeah.
It stops being priced by the market as a highly volatile, speculative growth stock and is recognized as a dominant, validated tech platform. It basically grows into its current high multiples through sheer scale and profitability.
So with everything on the table, what's the final verdict?
Based on the research, we're looking at an overall rating of 6 out of 10. The stance is neutral. It's a cautiously constructive base case.
To summarize the thesis, they have exceptional top-line revenue acceleration, but the gap between that revenue and their bottom-line cash generation is currently just too wide to ignore.
Right.
It requires very careful monitoring over the next few quarters.
The strongest long-term driver is definitely the mission-critical validation they are getting from compounding government and defense contracts. You simply do not get DARPA and the Space Development Agency relying on your tech if it doesn't fundamentally work.
That's a great point. But the biggest threat hovering over the stock is that accelerating cash burn crashing into SkyWater integration friction.
Yeah.
Which could lead to highly dilutive capital raises before they reach profitability. Now, if you want to organize your long-term stock research in one place and track these exact metrics, check out StockOracle through the special 14-day trial link below in the description.
Highly recommend it.
It brings fundamentals, intrinsic value estimates, AI bull and bear insights, moat analysis, stock comparisons, watch lists, and portfolio tools all into one place. Again, it is a research platform, not financial advice or recommendation to buy or sell.
Right.
Remember that AI insights and valuation estimates may be incomplete or wrong, so always verify important information and make your own decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, Please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
Think back to that 1950s mainframe computer. The math works and the contracts are signed. But the real question going forward isn't whether they can calculate the future. It's whether they can build the factory that builds the future before the money runs out. Definitely something to keep an eye on.